Welcome everybody to the ATAA remote chapter meeting for September. My name's Warren Manane. I'm the National President of the ATAA and also the President of the remote chapter. I'm hosting tonight's meeting in the absence of Daryl, who's on holidays. Tonight we have a presentation by Braden Gardiner, and it's trading the ASX with a defined edge and risk profile. I will now read the disclaimer, which we must do before we have the presentation. So the ATAA provides general material and information through presentations and publications with the aims of promoting theory and practice of technical analysis and assisting its members to become more competent technical analysts. Any material or information provided is made available for general personal use and education only. The ATAA makes no warranties as to the accuracy or the completeness of any information provided. The information provided does not constitute financial product advice. The ATAA makes no recommendations to invest in any financial product, nor to use any particular methods of investing. It is strongly recommended that you seek independent professional advice before making any financial decision or proceeding with any investment. The ATAA directors, affiliates, officers, employees, agents, contractors, successors or assigns will not accept any liability for any loss, damage or other injury resulting from use of the information provided. The information provided may include views and statements of third parties and do not necessarily reflect the views of the ATAA. The ATAA has taken all care to ensure that the material presented or published is based on information from sources that are considered reliable but takes no responsibility for the relevance and accuracy of this information. Further, the presence of any third-party material does not constitute an endorsement of the material itself or any associated organisations, products or services. So Braden has been a trader for many years. He started off on the dark side as a broker trading client funds and all sorts of financial products, and then later moving into trading his own funds. He's learnt and honed his skills in technical analysis and trading through many hours of study and repetition, and is now focused on education and trading the market with Davin Clark through tradesetup.com.au. So without further ado, I'll now hand the presentation over to Braden. Thank you, everybody.
I'll just leave it on that because I can't actually see if we get any questions. So what we'll do, we'll wait till, I guess, we'll get through the slides, and then any questions, we'll shoot them at the end. So as Warren mentioned, I've been in the industry previously from around 2002, I think, and then left that to trade my own funds around 2011. And since then, you had the ups and downs, but last few, probably 3 or 4 years have been going quite well. So I think learn a lot along the way. And what I've sort of settled on with my trading is, obviously I love technical analysis, but I love market structure. So the way I read market structure, hopefully I can get across to you a bit tonight and just explain to you what I'm looking for in different trades, different setups, and show you a couple of examples later on. You'll probably see on the left-hand side in the slides. So what I want to get through is just basically how I view some trades, what I view in market structure, and how I read it. Why, I mean, not necessarily, I do use indicators, but I think the action between buyers and sellers, you can see that on the chart, and it's quite clearly from the hard right edge from what you see with price action. You can't get that with indicators. Indicators are obviously the lagging effect. So I think that's, for me, is my prime area that I focus on. So we'll get started on that now. War stories, I could go through a few, but I might wait to the end. That's just from the beginning of my trading journey. I think when I first started, I might as well, I'll get through a few. When I first started in the industry, you'd be surprised how many brokers out there don't quite know what's going on. I was one of them years ago. Not knowing how to trade, it took me years to refine that and find my edge in the market. But initially, when I first started, I was trading probably, I don't know if anyone's ever been involved in the Aussie 10-year bonds or the 3-year bonds. I used to trade probably 300 a time intraday, in and out 300. So if you're trading around probably 400 at a time sometimes, I think that was around 50 or 60 grand a minimum tick. So if you're going for a couple of ticks, you're looking at 200 grand roughly. You're getting stopped out. So the movement for me when I first started in the industry was, God, it's like diving in the deep end. It didn't start with one or two contracts at a time. I started with taking over a bit of a book from some traders and jumping in the deep end. So started hard, and then once I started learning what I was doing, yeah, the confidence grew. But at the start, it was tough going. How I interpret the market. So like I said, I use price structure. And I think that's, for me, I find that the best way, and it suits my personality of understanding the markets, what's happening between buyers and sellers. I think our whole aim when we're viewing a chart, when we're trying to trade, is trying to figure out what interaction is going on between buyers and sellers. You don't want to get caught, obviously no one wants to get caught on the wrong side of the market. And if if you've got that wrong, or you're trying to guess what's happening in the market. And I think when I first started in the industry, that a lot of that was happening. You're just looking at a chart, you're looking at the really minute detail, and you're not understanding the bigger picture of which way the market's going, the bias for the market. And you can get caught offside, caught on the wrong side of the market, and then get squeezed out. So over the last, probably since I started trading for myself in 2011, my focus has been on trying to understand and interpret from a chart what the price action means. Where am I going to find the best opportunity? And what I'm really trying to do is build a picture. Like I said here, just build a picture for my market bias. So I want to know which way I should be biased, whether it's up, down, or sideways at times. Whether it be trading, for me, it's the same thing, trading shares, futures, CFDs, FX. Well, CFDs basically cover the whole kit and caboodle, but even trading options, I used to trade crude options. I don't know if anyone remember that, the massive spike when it went from about $60 to $140. If anyone was trading that at the time, I remembers that. I was trading calls, and I was just selling call options. Now, if anyone's got any experience in options, you know that that's, I guess when you're learning, you get told don't do that. That's the most riskiest kind of trading. It's open-ended for the downside and minimum gain. But when you're trading it, I mean, you're not just selling them and hoping for the best. There was a particular strategy I was using, and when the market was going nuts, and options, if anyone knows that volatility is a big part of the pricing, and it was, I wouldn't say money for jam, but it was really easy. You get a big spike into crude, and then I go sell a bunch of options. The market would eventually, over the coming days or week or so, would pull back, and most things will correct. And then I'm just buying them back. I wouldn't be holding them to expiry. It's always just trading them like anything else. If I was buying the market, you're trading it, you have a stop. But with the options, I was attacking it from a different perspective. I was, rather than waiting for that move up and taking advantage of the press up, I'm waiting for the press up and taking advantage of that pullback. Because with options, there's time decay, so they decay with time, and there's no way of stopping that. So it's kind of like getting free money in a way, where you can't get with futures, you can't get with CFDs. And you can't, and if you're buying options, you actually lose on that side. So that was, the same sort of thing. I'm trying to understand the price structure, what's happening in the market. So that's, my whole thing's based around, the action between buyers and sellers. Price action defining key levels. Key levels are very important, as everyone would know if you're new or experienced. Key levels gives you your best opportunity. Whether it's shorting into a market, I mean, you'd never just short willy-nilly. But you'd prefer to be shorting at a key level because you expect some sort of action or reaction at that level. And we'll go into it a bit more detail in a minute. Understanding why key levels are important. So I don't know if anyone knows what I'm talking about when I say the terms washouts. Washouts is when it gets to a level, and you'll get a lot of people will be waiting for that breakout. And then what the market does time and time again, a lot of the times it does it in futures, FX, not particularly in share trading. It can, and it's just trying to analyze, when do you think the market's going to take the stops and turn around and reverse. So what it does is two things. The market's approaching a resistance zone. Say it's popping up. I'll just draw it up, what I'm talking about. Say you've got a key zone here. The market's pushed up. You might have tested it. It pulls back. And then when we approach it a second time, or the first time, it doesn't really matter, but that's a key zone that you've marked up in place. The market can just pop up, wash those out, because that there's probably going to be buy stops up there, and it turn around and just retrace. So what that's doing is building up fuel for the reverse move. And I see a lot of opportunity in that style of trading. I don't know if anyone sort of follows or trades that sort of reversion to the mean, I guess we call it. But a lot of the time, you know that two things is people will be waiting up there to buy it, and they're just waiting for that breakout, and that's fuel. They get stopped into a trade, and then somewhere around here, whether it's halfway in the pullback or it could be below this high low, they've got their sell stop. So all that sort of selling fuel is ready to push the market down. And I think if you can get it at the right time and you understand what's happening, especially if you wait for that washout and you wait for a potential lower high, that creates a lot of opportunity. So we'll discuss that a bit later on. Let me just clear all that up. Okay, so for me, all these sorts of things are important when I'm trading. It's understanding what's happening at key levels. Can I expect a washout? I want to make sure that I'm trading in the known and the unknown. Sorry, I want to be trading in the unknown, not the known. So when I talk about that, when we say the unknown, so it's when the outcome is unknown. And if you've got a lot of experience, you know that that's probably the hardest time to pull the trigger a lot of the time, but it can be the most profitable time to pull the trigger. And we're talking when, say, the market's it's pushed up, you had a good expansion up, and then it's contracted or it's pulled back. You don't know what's going to happen then. No one knows what's going to happen then. But if you can get in at the right time and you've got good risk reward, that you're getting in early to a trend. So you're potentially looking for the start of a new trend up. And we call that the unknown because most people, I guess by nature, wait for more confirmation. And they're waiting for more indicators to tick off, or they're waiting for more, I don't know, they just don't want to be wrong. But by the time you figure out you're not wrong, everyone's into the trade. And it's sometimes I feel it's way too late. And that's why people get caught chasing the market, because they're sitting there waiting for confirmation. They've done their analysis, they're waiting for too long, and they wait till the market turns over or rolls over to the known. Okay, so once it becomes a known, everyone knows about it and they've got more confidence, let's jump in. But by then, everyone, the idea is that because everyone knows, everyone's either got into a position, got long, or they're not in, they're not going to trade. And then by then, who's left on the sidelines to keep pushing the market in your direction? So if you're buying in the known, generally you're going to be late to the trend or late to the party. And there is the risk that no one's left on the sidelines to continue the market in your direction. You could get in the washout like we just explained. Well, it's gone now, but we just explained before. And the market turns around and washes you out. And as long as you've got risk management in place, that's not so bad. But if you don't have risk management, like I think a lot of people do, and again, it's the ego that keeps you, from correct risk management, you can really get yourself in all sorts of strife. So that's what I'm striving really to get into the unknown. So I think the payouts are the biggest. You can have probably better than 1-to-1, I think at least 2-to-1, 3-to-1 sort of risk scenario. And if you do analyze it wrong and it falls short, it doesn't continue on high and you're happy to be trading into a resistance zone, but you just prive the resistance zone. The beauty of trading in the unknown, by the time it hits a resistance, you might have some sort of buffer behind you. And that just means when you get people, if you do get caught in a washout, it washes out. The people that are getting caught in that washout, if that makes sense, they're stopped into a trade. You've got in earlier because you've got in the unknown. It's become a bit more known at that stage. And you've got a bit of a buffer to realize when you're wrong and you can exit. So I think it's just, for me, even though it's potentially the hardest time to trade in the unknown because you don't know what the outcome's going to be. But hey, that's the idea of the whole idea of trading. No one knows what's going to happen. No one ever knows which way it's going to go, but it's all down to risk management and putting yourself in that prime position for it does play out to your plan, then you're going to take the most out of that trade. Also, the next thing I think is a key point is planning a trade and managing expectations, because you've got to plan ahead. The last thing you want to do is plan on the fly, get into a trade and then try to figure out what you expect from it on the fly. I think that's where you can get into trouble. But if you plan ahead, set up your trade and know what you expect, pretty much it's just a matter of sitting back and waiting for it to play out, or either play out or not play out, or prove you're right or prove you're wrong. But if it proves you're right and you get in, then you know what you expect. Now, if that changes, those expectations change, you can manage your trade accordingly. But if they don't change, it's, really it becomes nice and easy. The trade goes in your favor. It does what you think and you're taking profits on the way, either a partial or a full, however you trade. I'll go through also my basic indicators that I use, but like I said, I use a few different ones and I interpret them probably slightly differently. But my main thing is that in conjunction with price action. So for me, first and foremost is price action. Understanding the structure and building a picture for market bias, what I look for. I think I've just gone through a lot of these things. Price structure, I'm looking for key levels in an instrument. It doesn't matter, like I said, it doesn't matter what it is, whether I'm trading the futures market, indexes, currencies. I'm looking for key levels where I expect some action and reaction. So it's either people are going to lock away gains or people are going to look to get in, whether they're going to get in short. But I expect the action to pick up or the volume to pick up. And then I'm looking to interpret that, to analyze it and see whether I'm going to get into trade. And I'm planning ahead, obviously, but I'm obviously got what I want to see at that level. And if I see it, okay, I'm obliged by my trading plan. I'm obliged by my planning to jump in. Because the last thing you want to do, and I've done it so many times in the past, is plan ahead, know what you want to see it play out, and you're not on board. Because like I said before, you're waiting for more of the known. You want more confirmation. You're asking for more confirmation. By then, when you're right, it can go so fast that you don't get a chance to get that confirmation and you're kicking yourself. So markets for me, they go from, we say, contraction to consolidation to expansion, or expansion to consolidation or contraction. I don't like the term so much consolidation, but contraction to expansion. So if you're trading with the trend, it will expand higher if you're buying. So the market can, a trend up will expand higher. And then you're talking about contraction, which is, you use the term pullback, and then goes back into expansion until you hit some sort of key level where you find that the majority of buyers are happy to get out. And then you're looking for momentum to shift from the upside to the downside. You're looking for those key aspects of a market turn, and then you either take it all off the table, or you could potentially turn around and go short if it's according to your trading plan. We also want to know what phase the market is. So we want to know if it's in contraction or in expansion, essentially, or if you're just consolidating around the highs, or you're consolidating at a high or at a low. You want to know what's going on. And there's a few key things we look at, and it's got to do with anchors, which we'll discuss in a minute. Once they're, basically I will define each trend, whether it's trending or whether it's at a level, where the key level is, if it's broken, whether it's up or down. What does that mean? Does that mean a trend change, or does that mean just more of the same? You can range trade, but if it breaks out to the downside, I don't necessarily, I guess what I'm trying to say, I'll just draw it up. The market's popped up, it's got into a key, well, just draw that a bit straighter, into a key level. And then you start to sort of bounce around here, you might go down, but then you start forming this base. And then say it pops up to the top and it comes down. I won't sell just here, because we don't know, like I said, if that's a washout and it turns around and retraces back on you and gets you stopped out, or what it is. What I'm really looking for, because I think most traders won't just sell that break, because then your stop may have to be way on the other side of that channel or that range. You tend to want to see, I want to see evidence. So I'm always looking for shoulders, which we'll discuss in a minute. If in this case, if it's going down, I'm looking for that lower high. So what I would prefer to see, if we just go back a step, I don't mind if the market pulls back in here, then I'm looking for something like that. So that's your key shoulder, and you could have an inside shoulder, a key lower high or an inside lower high. So for me, that is serious confirmation. Once you've got that break of the level, anyone that's been buying off that level, they may not have got stopped out there, or they may have. But what it's going to do, that's going to create that uncertainty if you're a buyer, and the pressure starts to build on the downside. You might see volume start to pick up. You might see momentum shift from the upside to the downside with the indicators. But the idea behind the price action is that buyers are going to be put under pressure, and that's what you want to look at. We call it, what were just saying, sweaty hands, sweaty palms. So if anyone's been trading for a while, if you've been buying off that zone and you continue to do it, this could be over a day, it could be over a week, it could be any sort of time frame, but it's been working quite well. You buy, you sell, you buy, you sell, you buy on the low, sell on the high. There's going to come a time, if you bought here and it's went through and it starts to pick up, you're going to feel it, or you're going to sense it. You're going to know that potentially that it's changed, especially if you get, you've had this pullback before, then it kicks off. But this pullback, and it starts to get at this stage, when you've got that inside lower high, that's, for me, is a key. For me, it's a key setup on the short side, or if you're long, it's a key time to get out. Tighten your stop, tighten your risk, or just get out if you're long. But if you're looking for an entry short, especially after this break, that for me is the start of really that move down, or that trend has shifted. This could be distribution up here. What we talk about is distribution, meaning the trend has been up for quite a while and the sellers are starting to come in. Anyone that's bought it up there is starting to lock away some gains. You might get some shorts starting to come in, especially if you're looking at currencies or a futures market index trading. There'll be some shorts starting to build up here for whatever reason. They think that over the next day, week, month, the market's going to head south, and they're trying to build up a short position, but they're just selling off the highs. So that's why you start to form this range. It's still the uncertainty who's going to win out between buyers and sellers at this stage. Now, there's no real heads up that each one of the sides between buyers and sellers is going to win out. But once you get that break, to me, that's a clear sign. Okay, keep your guard up if you're long. Keep your guard up that you want to potentially tighten up your risk, or if you're looking for a short, get ready, because if we get this type of price action and we start to get lower high and we don't reach up to that high, that's just saying that sellers were stepping in here before, stepping here, stepping in, at the resistance zone. Now they're starting to step in lower. Why? Why are they starting to step in lower? Because the market's either running out of fuel in buying, or there's more fuel coming off the sidelines ready to jump in. But there's definitely a change in momentum or a shift in weighted numbers between buyers and sellers. So I hope that makes sense, but that's sort of one of the key concepts I'm looking for with my trading. Let me just go through. So we just talked about momentum shifts. We're talking about anchor charts. So I have an anchor chart. Doesn't matter if I'm trading shares, indexes. A lot of my background's been in futures and SPY trading, DAX trading, E-mini a bit, if I could stay up late enough, or the Dow. Anything that had a bit of volatility and a bit of movement, and currency futures mainly, not so much. I did trade FX, but a lot of those I would have an anchor chart, and I would start at the day, but my anchor chart may have been, say, an hourly or a 30-minute chart, and that's sort of where I'm trying to base my trends from, because I'm not hanging around for too long. I'm not sitting there for days. So that would be my anchor chart, where I'm trying to determine which way or which phase, we just mentioned contraction, expansion, which phase the market's in. And then I might have a trading chart off for 5 minutes. Sometimes I would even use a 1-minute chart as a trading chart as my entries, but 5 minutes more for the key levels, when we're trying to get into the unknown, if that makes sense. So we'll go over that in a minute. And then, like I said, you have your trading charts where you're trying to define your entries and your exits. Now, what I'll do before the open, I'll quickly get through this. I just basically like to look at everything that's happened overnight. You might look at, so we do with trade setup, I do a morning talk about 9:45 every morning, and just talk about what happened overnight and what does that mean for us during the market. And I've got the SPY chart where I will put my levels on my SPY chart, because the SPY is moving around with the overall index, and they do use the SPY to hedge. You might get funds, portfolios, big portfolios that are using that SPY to hedge intraday. So you do get your levels, they trade off levels, and I'm using that SPY to look at where I might get some action and reaction. So we talk about that in the morning. Anyone that wants some more info, we'll get to it at the end. If you want to join in, I'll give you the email address. But yeah, that's what we do in the morning, prepping ahead, deciding what I think is going to happen, how I should attack it for the day, and looking for levels where I expect some sort of liquidity. And by liquidity, I mean where I expect some sort of action or reaction. It's not generally in between a support and resistance zone, because that's an each way bet for me. It's a 50-50 game, whether it's going to go up or continue up or turn around there or chop around, and you can really get chopped up in between key levels of liquidity. So you're looking for that levels and what you expect to happen, and then plan ahead. So it's already marking everything up on a chart, putting a few scenarios together, and then really attacking it if it plays out. Yeah, so that's pretty much the morning setup. So this, let me just get down a bit, scroll down. Can everyone see that clear enough? Just going to make sure those headings are in place. So if I maximize it to the full screen, I tend to can't see the chat commentary on the other screen. So sorry about that if it's a bit of a pain. I hope everyone can see that okay. Just give me a yes if it's all right. Oh, Bobby, fantastic, mate. Fantastic. All right. So my key concepts when I talk about anchors, I mean, everyone might see them as swing levels. There's different names for them. I just term them as anchors. And that's what I'm trying to trade from on a trend down. I'm trying to define those anchors, but it's not just looking for opportunities to sell and just selling what would say, if the market's coming up into an anchor and you're looking for a selling opportunity, I'm not just selling willy-nilly and just sitting on the offer, because I don't know if that's going to be an anchor. I don't know if that's going to continue higher. I don't know anything, but that's why I like to look for scenarios like shoulders, which we'll discuss in a minute. But this is my general approach to a market when it's trending. It could be trending off a good liquidity zone of resistance, where the market has pushed up. It started to consolidate, like this. The market's pushed up, consolidate, and we're starting that trend down. And this might be the first lower high in a trend down. This, just matching up to here. And then what we're looking for is the market to expand lower. Then you get that contraction. So you get sellers that might just be shorter term. You don't know what sort of time frame they're trading from. Start to look to book some profits, take some risk off the table, get out, re-enter, get out, re-enter. Or you got the other traders that might just be looking for that expansion. It pops up. They look for contraction back up, look for it to roll over. They might add to a position, or they might just move their stop down. So they're trying to trade the bigger trend rather than the little minor minute trends in between. But that's the key concept. So each anchor, I'm saying, is just above the high, the lower high, lower high. So as it makes a new lower high, for me, it's got to break through the low, the previous low. You can see in pink. Once it breaks through that, it's a confirmed lower high. So I might move my stop down there. If I'm trying to trade the whole trend down, and then watch the market move, you get that reaction back up, starts to hold, more sellers come in here, you see a new opportunity, it starts to push down, breaks the low, creates a new anchor level. So these anchor levels are quite important when you're trying to assess also when to get into a trade, not just for following a trade, following a trend down or following a trend up. It's actually also very relevant, I think, to understand where your anchors are if you're expecting a trend change, because if the anchor doesn't get broken, if this anchor doesn't get broken on the downside, we can get the market chop all the way up. But if that anchor, the previous anchor, doesn't break, the trend is still down in my terms. Just because I've drawn a line of resistance down doesn't mean anything to me. I like to do that for more of it's a tool to try to understand what's happening. But for me, until people are forced out of the market, the trend is still intact. Does that make sense? So up until the market's pressed down, if this continues up, it can get all the way up and retest that anchor. But until that anchor's broken, no one really is probably forced to get out of the market. Well, technically, okay, whether this is a 1 minute trend, a 5 minute trend, a 30-minute trend, but that's the concept that I'm trying to follow. Okay, so these anchors we'll go into in a minute. I'll give you an example here. This is just what we mentioned. This is an example we'll use later on to discuss a trade. But this is the concept. So the market's pressed up. We found some sort of resistance. This might be longer term resistance. This might be anything, but we've just defined that as a resistance zone. Right, so the market starts to trend low. You've got that expansion lower. Then you've got a bit of contraction up. As soon as you break through the low, that's our anchor. All right, so then we get that expansion lower. So when it contracts back up, it can contract up savagely, like a sharp bounce, and then resume the trend down, or it can be a bit more controlled. And by controlled, I mean, you get this little pop-up, pullback, high, low, pop-up. And a lot of people might be fluffed out of a trade at that stage because they see a high, low, and they might think, hang on a sec, I'm going to get out. And then they walk away and they see that it's gone down another 100 pips in their favor, but they got out a bit too early. It's because they're not, I'm guessing, they're not potentially understanding exactly what's happened for the overall trend, and they're not clear on their anchors. They're not clear on what the market's actually trying to tell them. Because we know that, like I said, the market goes in waves. Some people, we call it the Dow theory. Dow theory, higher highs, higher lows for a trend up, lower highs, lower lows for a trend down. I'm just terming it as anchors. And I think those key levels, those swing levels, are where pressure is going to be put on. Okay, pressure is going to be applied to either the longs or the shorts. So that's a good example. So you can see the market still pushing lower. You've got a lower high in here. This is what I would term a shoulder to the trend down. And that for me is a prime entry spot, which we'll show you a bit more detail later on. And then the market continues to expand lower. So at this stage, when we can see the market's pressed down to the lows, you get that pop down. This for me is kind of important. I think it's very important actually. And this is where I think people can come unstuck a bit. And it's just And I think that's probably the art of technical analysis, is trying to define when anyone can see. I guess most people can see when that trend's moving down. They know to sell into pullbacks. You know, if it pulls back, they look to sell into it. They look to sell into it. But here they might look to sell. They might look to sell on the offer there, but they don't realize that it's broken through, okay, or it's reacted off that. So when a market can't press through a previous low, it's a bit of a heads up. Okay, it's a big heads up to be careful and to take note, because it just means that there's a supply of selling pressure. Oh, sorry, there's a supply of buyers that are starting to stack up at a certain level. Okay, so when you're getting this type of trend down, okay, it's expanding lower. There's no real pressure from buyers. There's no buyers standing in the way of that trend. They're all sellers. They want to get out or they want to get in. So anyone that's bought it and trying to get stopped out, they're piling in on the sell side. And there's buyers that are sitting there waiting, hey, let's just wait to see what happens. So there's a clear weight of numbers on the sell side as opposed to the buy side. But when you start getting late in the trend, the dynamics is always going to change. And we've seen that time and time again. And it's just a repetitive type of price action you see in markets. So when you get later in the trend, and we might say this is, you know, we've had 1, 2, 3 waves down, or 3 moves down, 3 legs down. This time the market's pressed up like it has before. We started to get sellers come in. Sellers have pushed it down, but then what we've got is you can see this initial first pop up, and then it's come down, expanded into that zone, back into the low, the previous low, but it hasn't broken through before we started to react. So for me, your key level, I don't know if anyone can see it, I don't know, it's probably around 75, 85. As soon as we got up through this lower high, something for me has changed, and it's very important. You can wait till it gets up through the anchor, because by the time we get this retest down here, that's a defined anchor in red, you know, just below 75, 90. So that becomes your defined anchor. And if we start to break that, okay, you've got to expect we're either, this is expansion lower, or we're either going to go into consolidation of those lows and just start to range trade, start to chop around, or we're going to start to reverse that trend. And it might be on a bigger time frame when we're going into contraction back up before we get the next big leg down. Does that make sense? So for me, it's always important to know exactly what's happening. If I come to a chart at this stage, I might take the opportunity to go, okay, I know where my risk is here. I want to sell on the shoulder. I know my risk is just above that. I'm looking for continuation down. Okay, it gets through this low quite easily, you know, expands through there, takes out this low quite easily, and really expands through. So by the time this red candle's finished, I know I'm on the right side of the market. Okay, can anyone see just what I'm talking about, this candle just here? That's it, well and truly expanded through those lows. So I know, okay, there's still not many buyers that are willing to stand in the way of that trend, okay, and soak up that selling pressure and provide the fuel to either stop the trend or reverse the trend. So that there, I could be quite confident that the market's going to expand lower, and it did. We saw that. I mean, this is all in hindsight, but we saw that expand lower. We've got that first reaction back up, okay. I might be looking at this thinking, okay, I'm short from here. I'm in profit. That's great. We got that expansion lower again. Okay, that's great. Same sort of reaction we saw here, and we saw it up here, and we saw that previously. So there's no reason to think that something's changing at this point. As soon as you get that reaction back up, and we take out that minor level there, for me, something's changed. Okay, and I might want to keep on guard. And I generally wait for the anchor to be broken, because you can see it's pressed down here, and it started to happen the same sort of thing. We get that contraction before we get that capitulation lower again. But it didn't break that anchor at all. Well, that's the anchor at that stage, wasn't it? Yeah, it was way up here, so it was nowhere near that anchor. But at this stage, yeah, we've got that expansion low. It's starting to come back in, and that's a confirmed anchor at that stage. Once you get this couple of good green candles, and then we're going to be thinking, okay, let's protect it. Let's move our risk right down to here. Let's at least lock in some gains. And if I get stopped out, I'm back on the sidelines. I don't care. I've locked away again, and I just reassess the action. And I might look, it might contract up, start to roll over, and I've got a secondary entry, or I could reestablish another short position. But the last thing I want to do is just wait and let it come all the way back and be up 100 points and end up taking a 20-point loss. That's the last thing you want to do. So the idea for me with trading is trying to get out. I do like to try to follow the trend, but what I like to do, say I got into this entry, I might get into 3 contracts on the futures, for example. If you're trading CFDs, you might do $100 a point and take it off in stages. So I would prefer to look at expansion lower, get your first sign of weakness where you might get that bounce, take some off, take a partial. This secondary expansion, I might take another partial, you know, somewhere potentially around here. But the third one, I'm really trying to let go. I want to see, because I don't know how far this is going to go. I don't know where it's going to stop, but I'm trying to follow it with the anchors. And that's my prime objective. And I think that's the best way you'll find to maximize your profits. I hope that makes sense, but we'll go step forward. It's got to bear up the time there. So key concepts, I failed highs and failed lows. There's probably not a lot to talk about there. What I would, I mean, everyone has done some sort of candle analysis. You're looking for those pin bars, I guess. And a lot of times it's got to do with when it gets to a certain level, and it's more at a certain level where you expect something to happen. Okay, so when you get this sort of pop up and you get this pullback, okay, in this zone, according to my indicators, say I'm looking like I'm oversold. I think this is a good zone where I should expect some sort of reversal or some sort of move back up. And you're just looking for those failed levels and then potentially a higher low. And the same on the reverse side, when you get extended on the upside, you're looking for some sort of failed level and then failing to get back up there again and put pressure on those sellers again. If instead the sellers are coming in a bit more force, you're getting that failed high. This is a failed low, again, a failed low here. That sort of concept. So once you take note of that, you can start to read in what could be happening. So we know the bigger picture, the market might have contracted lower. We're starting to expand higher. We're taking out that high. Okay, we're just looking at the Dow theory. Like we said just before with our anchors, we get that contraction lower. At this stage, somewhere around here, we're expecting some sort of expansion again. Okay, we get a failed low, that rejection there, higher low in here, and we're starting to get that expansion. So we're following that expansion back up. And then we're getting that contraction again. Okay, same sort of process, looking for your higher low to play out. And then we get this push up, sorry about that, push up, pop up, push up, there you go. And we should be gunning for those highs, but when you start to fail again, then to me that dynamics has changed. So we're just trying to really, with failed highs, failed lows, we want to put it into context of the overall price action. And what does that mean when you're talking about expansion and contraction of market or waves of market, whatever you want to say? Let's get to the next. Okay, the next slide is on shoulders. So for me, this is a key entry criteria because I feel that shoulders for me are the best way to enter a trade. It's the best way, and it's just what we said before with failed levels. You know, failure to continue higher is always a good sign that the market's starting to find some weakness, or failure to continue lower is a surefire sign that the market's failing to continue lower and you're starting to get some buying pressure step in. Now, you never know where that's going to happen. So if we're looking at this trend here at the far left-hand side, the market's pressing up. At this stage, when it's still good, we don't know where it's going. We don't want to just you know, buy here. Oh, sorry, I'm trying to find. We just don't want to just buy on the rise. You know where your risk is, but let's just flick that around. On the way up, we don't want to just sell willy-nilly because you don't know exactly what's going to happen. Say, you know, you got this pop up, pull back. You're looking to sell into this high. You're selling the high, failed. You get stopped out. Okay, you try it again, sell into the high. You get stopped out again when it rises and expands up. So this is all part of this little move up. Then you get, you know, third time lucky, you might have missed that trade because you're waiting for it to retest that high and you're just sitting on the offer, is what we say before. So I'm a firm believer. I don't sit on the bid, I don't sit on the offer, meaning that I don't just wait for it to come into a support zone and just put my resting bid in there and hope that a 10 or 15 or 20 point stop is going to keep me out of trouble. What I'm looking for is a shoulder. I'm always looking for a shoulder because I think that's a surefire method that, you know, this trend is starting to come to an end. There's something happening. There's a change in dynamics. I get the shoulder here. Even that's probably a little bit early, but even here, you get a shoulder. It's a definite shoulder. So that's a definite change in trend. And then you're looking for that expansion lower. Then when you get the contraction back up, that trend, so we're looking at this overall trend down, I'm looking for the shoulder again. So what that gives me is two things. It gives me a clear area where I can get involved in the short side, knowing that there is potentially a lot of other people thinking the same thing, or there's a lot of sell pressure starting to come in because it's failure to get up to that previous high. Okay, so the buyers are running out of puff, essentially. So buyers in green here, you know, they're pressing it up, pressing it up, pressing it up. So like I said, if you sell at just at this say you've marked up that as a high, you set a resting sell order there, you've just been stopped out, and then you do the same thing here, you get stopped out because you just don't know if it's going to go through or if it's going to stall there. But what you do get once it starts to fail, and especially with the move down like that, it breaks the anchor. So this is the anchor to the move up. That push down takes out the previous high low. And then we've got, okay, we definitely from there, I'm looking for a shoulder. Every day of the week, I'll be looking for the shoulder, and I'm looking for that. I'm trying to trade in this zone because I feel that's the unknown of the next wave down. Does that make sense? So shoulders for me, I find as a prime entry to try to get in nice and early, and it's the first sign of failure, the first sign of failure for these buyers to continue that move up, and sellers are starting to come in. Okay, so that's how I like to structure my trades. So using shoulders, I think, is a really good way to do that. Get on to the next slide. So this is a live slide, or not a live slide. It's probably, I think, on the Aussie or the Euro for a member, but it's just illustrating shoulders in action. So this is what we've got here. We've got that, just going back, the green move up. We've got that, contraction up. So we're just calling that contraction because the overall trend is down. So from the left-hand side, it's contracted up, and we're looking to get involved in the expansion because we want to stick with the overall trend from and we're basing that off our anchor chart, which we mentioned before, whether that's your 30-minute chart and you're trading, this is a 5-minute time frame, and we're looking to continue that 30-minute move down. So we're just getting the wave, we're just getting the pullback on the 30, but we're looking to our lower time frames to refine that. And like I said, that's a 5-minute for me. If I'm looking at shares, I might use, it's probably not as common, but I would also look at the weekly charts, and then I would look at the daily because the time frames are different. But if you're trading intraday, you might look at the daily, you might look at a 30-minute chart, and you might trade off the 5 or the 1 if you're an intraday stock trader. For me, it's all the same type of thing, and you're just trying to base it off an anchor chart, which you call it. So yeah, this is expansion up. We're looking to get involved in the contraction up. We're looking to get involved in the expansion lower and take advantage of that move down. And you know when you're right, because say this is a shoulder we're looking at. I think this is a prime shoulder. All right. And if anyone remembers the ASX when it tipped over, was it last year, 2018? Yeah, 2018, about September, October. The market was grinding up. It was grinding up, and then you got that first breakout of that grind up. It really pressed down quite hard. There would have been a lot of people still long looking at that thinking, oh, okay, that dynamics has probably changed, but hey, that could just be a aberration that's pushed down, it's going to pop back up. The world's going to be rosy again, and it's going to continue on. What we saw at that stage after that press down was this kind of grind action. Now, every day of the week, that grindy action after a move up like that, and you've broken that trend, potentially broken that trend, is going to be a shoulder, because what that's saying to me, if you can't get this kind of expansion higher, a number of green candles in a row, and instead you get green, green, red, green, red, green, red, all that sort of stuff, like we're seeing in this zone, sellers are starting to come in, okay? And they're holding it down. So if I use a stochastic indicator, if I'm going from, say the market got overbought here, got oversold, got overbought up here, got oversold. But then at this stage, the stochastic's gone overbought again. You've got to compare, last time it was overbought, it was up here. So what that would suggest with your stochastic indicator or oscillator, whatever you want to call it, is that sellers are stepping in at a lower level. Okay, for whatever reason, they either want to be in the market and get short, or the longs are trying to get out, and they're trying to do it in numbers. Okay, so it's just a change in dynamics between the buyers and sellers. It means that when your stochastics goes from oversold to overbought, it means they're given a good nudge to push it up, but the selling pressure is quite strong, and the selling pressure is increasing because it's keeping it down at a lower level. So they're not waiting for it to get up here again to sell. They're coming in at lower levels, and that's why it's a prime entry for me to take advantage of. And when you're right, because you get this kind of action play out, it really starts to expand on the downside. And that to me, is a perfect trade because there's no pressure. And when you're right, if there's no pressure, you can just sit back and watch it and just follow your anchors on the way down. Reduce your risk, manage your risk on the way down, and just try to lock in as much gains as you can. And then if it plays out, this might be, like I said before, you might be all in with 3. Or you might have the idea this trend is going to go on for a while, so I'm going to build a position, add, and then take it all up and take it all off into a major support. I tend to attack it all in one go. I tend to short my maximum position, knowing exactly where my risk is, and then take it off when it expands, trying to take some risk off the table and build, and then letting that final third really work out in my favor and see how far it can actually go. So I don't mind opening it up for the last third. Okay, does that make sense? Still coming through loud and clear? All right, so yeah, you can see just what played out after that. Prime entry, and I call that, if that's, say the market was chopping around here and we got a high here, retested a major key level high, and we started to get a shoulder play out like that, I would call that the unknown. Okay, this, yeah, it's not the unknown, but by then, at this stage, the trend's going, and at this stage, if you're selling down here, you definitely know the trend is going down. And I'd say that's laid into that wave down. That could be laid into the overall trend. You might sell it here and have a stop way out here. But for me, that's way too risky. I would rather not be in the trade at all than trade in that zone. I would rather wait to see a key lower high and try to get involved in a shoulder. And you can see each one of these waves down, you get that contraction back up, you get a shoulder. Each time you get some sort of lower high coming into play, sellers coming in lower for whatever reason, starting to force that market down. So they're not finished selling yet. All right. So in that, what I mean by that is if there's a whole buys, if this is major trend up and this is a change in a major trend, there's sellers coming in. At this stage, they're not finished because they're continuing to step in at a lower level. All right, and pressure that market down, and then you get that secondary wave up. Again, you've got a shoulder to get involved in. And again, the key reason behind a shoulder is to minimize your risk with the greatest payout. All right, so that's a concept. We'll talk about now defining key levels and what we're looking at. So defining key levels for me is I'm just trying to build a picture. And this is what I would do each morning. And whether it's a long-term trade, a short-term trade, I'm always trying to define my key levels, where I want to get involved. And I don't want to put my money at risk anywhere. I want to put it at risk where there's the highest odds of payout, the highest probability trade. And like I said, it's probably going to be more than likely in the unknown because I don't know what's going to happen. But when you're putting it in the unknown, the odds of payout or the payout is going to be a lot greater because what you're doing is if you get it right, it becomes the known, you're already been in for a while, you're going to be selling it to some poor unsuspecting victim that's getting out a little bit late. Sorry, getting in a little bit late or chasing the trend or that fear of missing out that causes people to get in really late and chase the market higher or chase it lower. So I'm trying to build that picture at the start of my trading day, whether it be trading shares, longer term, I'm trying to build the picture of what I want to see and plan it out. So if I do see that, I've got no complaint. I have to get in. I have to follow my plan. I have to follow my preparation, my key levels, and I'm obliged to get in and execute the trade, to enter the trade or pull the trigger. So prepping the market for me is very important, and you really want to prep your anchor chart of what phase of the market you're in. Define your bias, whether you think it's going up or down. Is the market on your anchor chart trending down? Is it trending up? Is it consolidating? Is it range trading? What sort of phase that market's in? I mean, because each day you come to the computer, you flick it on, the market could be in a different phase. We know we get those trending days where it's quite easy. The next day you go, okay, it's going to be a trending day. Let's look at another day like yesterday, and it doesn't. It can go sideways. It can do nothing. It could chop around. And you have to be able to identify those different market phases. And you can only get that through preparation and prepping a market. If you just jump in after a trending day and you're expecting the same thing, you're not really thinking about it, not knowing where your key levels are, where you're going to get some liquidity, then you're sure to get chopped around. Well, I know I've done that. I've done it many times in the past. And I think in the past, it's just proven to me how important it is to prep up a market, mark up where you want to get involved, mark up even what sort of action you want to see into a market, which I've got an example coming up in just a minute. Yeah, let's get onto that now, actually. Understanding why key levels are important. We want to understand why they're important because we can expect washouts at those levels. we want to make sure that we're getting into the unknown, like I was mentioning a few times before. And we want to make sure that at a key level, if the market's extended into a key level, can we expect it to pull back, or can we expect all that fuel that's built up, whether it's on the long side or the short side, into that key zone? Just say the fuel's been the bias has been up. It's been up for quite a while, and it's come into a key zone. All that buying pressure that's been building up, it has built up for quite a while. You've got to think of that as fuel. It's fuel to turn the market potentially, as long as you're trading to your setups. It's fuel to move the market down, because we all know that we get the longer the trade goes on. I know that for myself, that the longer I'm in a trade that's going in my favor, the more on edge I get, because I know that sooner or later this thing's going to turn. And I want to try and lock in as much as possible. So I start to get a bit, not anxious, I guess, but I start to get a bit more edgy, and I'm making sure that I'm tightening up my risk. So at the start, when I've got it in the unknown and I've got it right, it starts to go in my favor. I'm a bit more looser with my risk, because I need to give it some time to start to play out. And when it starts to get into that known area, when the market, everyone can see that it's going up and everyone starts to trade it. And if you want to trade, you jump in. When it starts to get to that kind of level, I want to tighten up my risk, because I know that sooner or later someone's going to unload on it, or we're going to get the market turn. It's going to come down, and I don't want to get caught with loose risk then, because I think you're giving up way too much. Okay. Like I said, key levels, you expect action, reaction. We expect buyers and sellers to take some sort of action in those levels. We want to know if the move is extended. So it's important to know if it's extended into a zone, because I tend to feel if it's extended up into a resistance zone, for example, and all my oscillators are starting to say that the momentum is slowing. The momentum is probably already slowed into that zone. The stochastic indicator might be well and truly overbought and rolling over. All that to me is saying prepare for a washout. And I would never buy on a break on the upside in that case, because 9 times out of 10 I'm expecting a washout of that zone. And let's just clear this up. Sorry, I'll draw off exactly what I'm saying. And generally, whoops, I don't want to circle. Say that's our resistance zone, and you've got the trend has been up into that zone. You've got this extension up into that zone. If all my indicators at that stage are extended and they're showing that momentum is changing, momentum's rolling over, momentum, like I said, could be well and truly starting to roll over by then, I don't want to buy on that break there. I would never buy on the break there of a key level and have my stop way down there. I would always let something happen, let some heat come out of the market. And then if you I'll change it into a different color. If from here, I start to get a high low play out like this, yeah, I might want to take an entry long. I'm happy to do that, because I know from there, I know exactly where my risk is. You can say you box it up, you box up your risk, you know where you're getting in. I would buy on a stop there, because I know it's had a decent pullback. But to me, things are they're still looking strong. Maybe they're ready to blow through this resistance zone, because we never know. We never know what's going to happen, whether it's going to back off from there and change trend, or whether it's going to continue. But I would never buy on that first break of that trend. If I'm wrong and it keeps going, so be it. I'll move on to something else. So I know that more often than not, if my indicators are showing that the market's very stretched, very extended into that zone, I could probably bet on that it's going to be a washout. All right, so I guess that's a little point, but if you get something like this, I'm happy to get into. You might also get that it just, from here, just extends back in, and then you start building this type of action. And if I get that action, yeah, I'm going short, okay? Because it's already washed out, it's pulled back. Anyone that's got stopped into a trade there, who's got risk down here, and they start to see it failing at a lower level, let's just draw that a bit clearer. So it's pressed up here at a lower level, and they're starting to get this action. They're probably going to get out, because that, to me, that's your first reaction lower. Then it starts to press up again, and this is your second reaction lower. It's a key lower high. So a key lower high to me means, okay, bail. All right. Or you're going short there, because you've got to remember there's all this fuel that's built up on the upside that is going to be thinking the same thing. So there's going to be waves of sellers starting to come in. And if I can get in nice and early on the short side and see if it can expand lower, great. I've got a short on my hand. I've got a good trading opportunity with limited risk. All right, let's how are we going for time? We're okay. It's nearly 9 o'clock, so probably only about 15, 20 minutes, if that's okay. Everyone good with that? Happy with my yabbering on? So defining key levels. What I want to look at here, this is my, I just want to say this is my anchor chart. Okay, whatever, this could be a 30-minute, it could be an hourly, it could be a daily. Either way, I've defined this as my anchor chart. And what I would do from here, and we're going to look at this, this is the area basically from this blue line we're going to analyze as a trade and opportunity. I mean, I know I've got it marked up, we know which way it's going, but we're going to define our key levels first. We're going to, from that information, we're going to try to extract a trade, and we're going to assume we don't know what's happening in this zone here, where we've only got the information up until this blue line. Basically from this red arrow forward, we don't know what's going to happen. Okay, so just take that major assumption. So from there, the next step I would do from my anchor chart is just mark up my levels. So I know, okay, we've got a key high up here. Okay, potentially that's going to provide some sort of resistance up there. The market started pressing down. It's still technically going up. You could have, I guess, I'm pretty, I guess, for not lack of a better word, anal about my zones when I do put in these rising support or falling support like resistance lines. The reason why I haven't gone through this low or this low is because basically of this one candle. Okay, I'll take it across here because I think that's quite right. And you see that it was respected, well, 21 if that's the 21st. So you can see it was respected here as well when the market started reacting back up off that level. So that's why I've defined that key support zone there, and I've defined it on the upside just going through the major highs. So at this stage, you can see anywhere in here, we don't know what's going to happen. We could have had a short depending on the time frame. We could have analyzed this for a short. Okay, jump in, lower high, going from a key potential lower high at this stage. We've got the shoulder here, extend down. Okay, it started to bounce back up. We're out. All right, but what we're analyzing is at this stage what is happening, and what you can see is sellers starting to take control. And the reason I would say that is because we've got this break through the low. I mean, that's not anything serious, but it's a lot different to just, 1 or 2 points. That could be 5 to 10 points, a break through that low. And you can see that buyers are starting to fail, okay? They're not stepping in a bit early above this previous low. They're letting it get broken through. And then when it pops up, sellers are still stepping in at lower levels, all right? So you've got all the way down here. You get the high put in place, lower high, lower high, lower high, lower high. So for whatever reason, every time it pops up, sellers are getting in at lower levels. They're starting to stack up. So if you're on the long side, sooner or later you're going to be feeling the pressure, and you're going to either think about getting out or think about locking in some gains, or potentially, like I said, thinking about jumping in the short side. And then as we get to the, we approach this blue line there, that candle, we can see that it's actually taken out that 111.25 zone. Okay, so there's clear buy starting to form. So from that price action, what I'm seeing is that we're getting contraction. So by having a rising support and falling resistance, you've got a point of agreement. The market is coming to a point of agreement. So every time the market comes to a point of agreement, we're going to be ready for either a break up or a breakdown. We don't know which way it's going to go, so we don't ever try to anticipate it. Like prior to that, you wouldn't think, oh, it's going to break up to the top side, I buy here, and all of a sudden I've just been stopped out. I'll try again. Oh, I've been stopped out. You don't want to do that. You want to wait till the market shows you what it's going to do. It basically show its hand, and then you're looking for your setup. Okay, so by this stage, I've got a heads up here. Okay, yeah, maybe yes or no, but I want to be starting to look for the shorts. Okay, we've got the pop up. I'm confirming that by sellers coming in at lower levels. All right, that's good. The market extends a bit lower again this time before it bounces. All right, to me, that's a clear heads up because you've got through this support zone, and you're tending to roll out of that point of agreement to the downside. So let's take it to the next step and again, this is just from that, we just step back. We're looking at the action purely from this blue line onwards. All right, so we've got our bias. We want to be down. We want to look for a short. So it's really just planning out our trade. So from here at that stage, the action we've assessed, we want to be biased down. We've got our anchor chart that says, okay, you want to be down on the short side. You want to be looking for sells. you don't want to be looking on the long side because there's a good chance you're going to get cleaned up. I would always draw out what I want to see. So if I'm going to get short, this is what I want to see. And I will draw up the other side, even if I'm biased down, because I could be wrong. All right. If we start to get this kind of action play out and there's failure, look, maybe there was a massive washout. The dynamics have changed fairly quickly. Here, after this, the dynamics have changed. It's starting to hold a higher level and it's going to squeeze on the upside. We don't know. All we can do is try to get our bias, attack the trade, plan it out, and wait to see our entries. Once you get the entry sets up, basically that's the last form of confirmation that you are right, and you really, like I said, you're obliged to participate on the short side. So we can see here, I've drawn up a scenario that I would like to see. I mean, with limited information, we might have to wait for a bit more information to play out before we can reassess that. But this is a basic kind of price action I want to get involved in. And I might look for an entry here. The market presses down, pops up, we get a lower high come into play, and then starts to press down. I might get a short through an entry through the previous low. But it's probably a bit aggressive because we've still got this low in place. And at that stage, that's your key low. All right. So that might be a bit aggressive because it hasn't broken. It could easily do that, get me in, rebound off there, and then start to build this price action. And then I get stopped out. Okay, so be it. For me, this is prime because you do get that breakthrough. All right, break through that support. It's bounced back. I've got my lower high. I've got my shoulder. I'm still in the unknown, and I'm getting short. Okay, I've got limited risk. I know exactly where my risk is, and I know that this cleanup followed by a lower high generally leads to lower prices. All right, and I could pretty much write that scenario off at that stage, and then a matter of just hoping that it continues on enough for you to make some good money. All right, so if we go to the next slide, oh, I went the wrong way. That's right. So this is not much different. It's just putting in my key level, which is the red line there. I should have deleted this one, but anyway. So what we've got a bit more action. We've got a bit more price action that's played out. So from here, we assessed it at this stage. The market's gapped down. It might have been the open on a Monday morning. The market's gapped down. And it tried to pop back up and retest these previous highs. Okay, but it really has failed when it's got up there. And again, you can see when the actions change, you get a couple of red candles thrown in there, as opposed to a lot of green candles in a row, really expanding, and wide-ranging candles, as in it's expanding higher. So when you get a wide body candle, a long green candle or a long red candle, that's strength. Okay, when you get a bit of a green candle throwing a red candle, the market's indecisive. It is going up, but it's not strong. It's not strong on the buy side. And then when it starts to fail, and especially when you're forming a lower high off the previous highs, okay, you've got to be watching for shorts. And at this stage, we can raise our entry level potentially to this second red line. So this is our initial one. We can raise that because I know that, okay, if it gets through there, I could potentially happy to go short and I could have my risk just up here, as long as the risk is not too much. And I think it's actually about 10 or 15 pips at that stage. Is that right? Probably about 10 or 15 pips. I think this is the euro. So that's not a lot if I'm going to at least attack down here. So 10 or 15, I might see that as 2 to 1, just attacking that low. All right, so if we go down to the next slide. All right, now for me, this is back to that scenario. I just want to flip back to. It's this scenario. It's broken a key level. All right, so we just go back 2 slides. You can see this red line we drawn in that secondary red line, or that support zone. It's just broken that. So for me, that's a clear sell. I might have sold there with my risk up here, but if I hadn't, if I'm looking at it there, or I was a bit indecisive for whatever reason, because it hasn't played out as clear as what I expect, that for me is a lot clearer because it has broken that level. To me, sellers are starting to take control. They've opened lower, they've popped back up to the highs, they've tried to retest, they failed at a lower level. Sellers are coming in again at lower levels. They mean they're getting a bit eager to get into the market, or they're getting eager to get out of the market if they're long. But either way, the dynamics are changing to the sell side and the momentum's starting to shift to the downside. And for me, that yellow line there, that represents the entry level. And from there, if it just fails from here, I know exactly where my risk is. By the time it turns, rolls over, as long as you've got this, the market respects that blue resistance zone or that downtrending line, then I think I well and truly got a trade on my hands. Does that make sense? So we know the market goes down. Let's just look at what happened. Well, let's look at what happened. So that worked out quite nicely. You can see we've got our lower high, we've got our shoulder play out, and then from there it's just a matter of marking up your little minor lower highs. And really, if you went short from here, the entry level which I've marked up, you can follow it down with these little minor anchors up until probably you get washed out here, or you might, if you have tight risk, this little pop up here. So you've got this green, couple of green candles, couple of red, the expansion back up again, flushed you out. So that, you get flushed out in times like that if you've got your risk just above that lower high. But either way, you've got a really handy profit. So if that had a 2-to-1 risk reward down here, or even 3-to-1 if you've got that style of entry, well, a small risk on that one as opposed to that initial risk that we mentioned before with the stop above the highs here, above that 112.05. That was a 2-to-1, so you can imagine that's probably about 3-to-1 down here. By the time you get stopped out, it's probably more like 5, 6-to-1. And I think any day of the week I'd be looking at taking that, and I'm happy to get stopped out there. If I can get a bit more out of it, that's fine. But either way, you can see that the trend is starting to get away from that trend line. Potentially it's starting to get away from, I use moving averages. The moving averages are expanding. That's late to the trend. So the later in the trend, the higher probability it's going to start to turn, or you're going to start to get failure on the downside, or failed continuation. And then you really want to start dropping your risk or tighten up your risk management. Does it make sense just going through that? So this one, it's more got to do with washouts, and I call it standing in the shoes of a trapped trader. So it's what we mentioned before, and it's probably what I did a lot earlier on in my career when I was more of a broker than anything else. Back when I was doing a few hundred contracts, I didn't really, to be honest, I didn't quite know what I was doing. I didn't understand charts as much. I didn't understand the price action, what I was looking at. I just looked, okay, I saw that low. If it breaks below there, I know I can put my risk up here. It pushes down. I want to enter, and then don't realize that you've got all this trend that could be off the chart that you don't see, or you're not understanding fully what the dynamics is going on, what between buyers and sellers, or what the bigger time frame is, what's happening on the bigger time frame. Okay, so a lot of the times that it can be primed for a washout, and I don't know what my indicators are doing. I don't know if it's stretched into that zone. So all these little factors that I now take into account for every trade I do that I probably didn't before, and I think a lot of people don't, and they could get primed for getting washed out of the market. And by washout, you're just thinking trap traders. So if you sold it through here and it starts to reverse, remember anyone that sold it there is going to be fuel. And a lot of the times, say here's a prime one, the market was chopping around. This could be a key resistance. The market may want to go down. It's trying to go down, but what it may need to do first, and it will do it, I think, if you go back and look at charts on indices, currencies, and futures, then you'll see washouts quite often, and the market will do it a lot. And what they're doing is getting extra liquidity. So the market might pop up, stop a few traders into it, and they might be sitting there soaking up that buying liquidity. Okay, so I think it's quite a big thing in bank trading. They might do a lot, and because you got to remember that all your technical analysis 101, you can get it from any bookstore. You can get a charting or a technical analysis. I'm having problems saying that word. A technical analyst book that gives you all your standard support resistance, how to identify support resistance, how to identify a trend using your moving averages. What does a stochastic do? But I think the failure is to interpret what price action is doing. Because if you can understand all the indicators, that's fine. But if you can't adapt it to what the price action is doing and use it to read what the price action, not vice versa, see the price action and reading it from the indicators, you're trying to use the indicators to read what's happening on a price action or between buyers and sellers. If you can't do that, I think you're going to be set up for a few little issues But anyway, that's what I think markets can do time again, because they know that people will look at things like that. They know that there's going to be, the markets say it's coming up. That's a key resistance zone. Just hold a high low here, high low. So they're going to be people up there going, I'll buy on the break up on the upside. I know it's a key resistance. If it gets through that, it's going to keep going, and I've got my risk below that low. So the market will pop it through. It stalls, it stretches into that level, it extends into that level, especially if you've got a couple of good green candles like that. A couple of good expansion candles up is going to entice anyone. Okay, or well, not anyone, but most people. I've got caught so many times like that, and it's just when you get yourself in a bit of a kerfuffle in trying to figure out what's going on. But I will buy that. I've done that in the past, but now I think I've come to terms with what's happening with washouts, and I'd rather let it play out. If I'm wrong and it keeps going, so be it. But if I'm right, I'm not going to get on the wrong side of the market. Okay, so that sort of price action pops up. It's going to get liquidity for the sellers, and you'll see that a lot of people will get caught with those washouts, although they're trapped. By trapped, they're bought into the market, and all of a sudden they see it start to reverse on them, and then sooner or later they're going to have to get out, whether they have risk right down here. And what a lot of people will do, which, I mean, again, I've done it in the past, and I think people will add to it. Their ego's saying that they're right. Okay, the ego's saying, no, you're right. You've analyzed it right, so let's just buy a bit more on this candle. Okay, it's touched on this low. That's okay. It's rising now. We've got a couple of green candles. Let's buy a few more. Add, okay, a couple of red candles. Oh, don't worry, this key lower down here will hold. I'll buy some more. And all of a sudden, it's popped out through the low. They see that the reverse of what we just saw up here. They go, oh, look, it's breaking down. I'm completely wrong. I've doubled up and I've tripled up. I'm getting out. And all of a sudden, you see it go pop, pop, and they were right. I know that probably sounds bad, but that can happen a lot. Washouts in the market. So that's why I find if I want to trade off my shoulders, see there's no shoulder here, no shoulder really in this move. That's not a shoulder, it's popped up. I don't see that as a defined shoulder. Okay, the market's moving down. We've got the big washout here. You've come back down. I see this more of a prime area, a shoulder to get into, because it's retested that low. Even if it just goes to the high, that's great. It did pop up and then failed. But I see that as more a key level. I mean, you've got a couple of narrow range candles, a bit of indecision. It's showing that it's potentially going to hold a higher level after this washout. We know there's going to be fuel on the sell side down here that could accelerate it up. But we don't know what's going to happen, but hey, it's worth the risk. Okay. All right, so we'll get through a couple of other things. Some of my basic indicators I use a 20 and a 50 EMA, exponential moving average. And that's to try to get me on the right side of the market. So if they're rolling over and they're starting to expand to the downside, I want to be short, and I want to be below the MAs. If it's on the upside, I want to be trying to buy on top of the MAs. All right, when they're expanding up, and along with all the other different things we were talking about, buying in the unknown, buying into expansion, and so on. I use stochastics. I use a stochastic at I think it's 1133, and I use that for more strength between buyers and sellers. I don't use it for overbought and oversold, although I do take note of it. It probably keeps me out of trades, but it won't keep me from getting out of trades if I've got some profit on the table, especially in shares, especially if it's extended. The market started to shoot up. The oscillator's saying it's overbought. It doesn't necessarily mean that I'll get out. I want to be proven wrong, and I know there's going to be a pullback. If it pops up and I get a lower high, I'm probably going to get stopped out, so be it. But if it doesn't, this whole time it can keep rallying day after day after day, and it can stay in the overbought zone for a couple of weeks. So I won't use it to get out, but it will keep me out of the trade. So if I'm looking to short into it, or probably not short, but if I'm looking to buy into it, if it's overbought, I will probably steer clear. Even though I could be right, I would probably steer clear of it. And I'd look at something that's a bit more primed, because I feel if it's in overbought with a stochastic, the buyers have pushed it up into that overbought territory. Even though if it's going up, I feel that I could be getting into the known, into the market when it's known. The market knows it's going up. So what I've got to, and this is only a guess, I have to guess that there's more people coming in after me to keep pushing the market higher. And I just can't come to terms with that, to buy in an extended market when it's overbought. I don't want to be basing my trading around guessing if there's more people to come in. I would rather buy it in the unknown and let everyone else guess and keep pushing it higher. Okay, so that's momentum. MACD I use more for momentum as well. And I think I can use it off the 20 a 20-50, not your standard, or I use a 10 and a 20 for fast and slow. I sort of muck around with that a bit. I look for washouts, extended markets. I look for trap traders because I think trap traders can produce a good turn in momentum, shift in momentum, whether it's downside or upside. I look for markets, again, going from contraction to expansion. And that to me, when it's going from contraction, it's turning to go in expansion. And that's what I'm trying to analyze. That prime position for me is where I'm jumping into the unknown and my payouts are going to be the highest. So this is just the trade setup. If you want any more information on that, I've got it just at the end of the slides. I've got a couple more slides to go. I can whip through those. So that's just our latest results over, I think it's the last couple of years, just on a model portfolio, up at about 109, 10% at the moment. I think that was from a couple of days ago. And that's just modeled off a 100 grand account. I think it's now over 200 after a couple of years, but just your stock standard share positions. It's not any futures in that. It's not any currencies. It's not margin. It's just standard share trading. Mechanical trading. So this is what I've been working on lately, and I think it helps me just refine it and make it more mechanical or a better trading strategy. And it's just, for me, I find it's taking the guesswork out of a trade. And these are what I'm basing my more intraday than anything else. And we're working towards doing education service based around this. But what I'll utilize is two charts, a 30-minute anchor chart, and I'll use a MACD and a momentum indicator. And I've just got a 20 EMA channel, as in the 20 EMA, then it's offset by a certain percentage, maybe 30% either side, on the upside and the downside. And that just gives me a channel. So from that channel, I'll show you in a minute, I can see whether the market's getting extended. So I'm looking for a reversion to the mean style of trade. We call it an outside in, back to the MA. Or if it's on the 20 MA and the MA is angling up, it's starting to sit on the MA, I want to look for an inside out. So I want to look for more of a continuation style of trade. And I trade off the 5-minute chart. And I'm using the MACD and the momentum to get me on the right side of the chart, both on the 30 and the 5. Okay, there would be two basic trading styles, like I just said, reversion to the mean and continuation. Whip through the next one. So this is more of your continuation style of trading. Okay, so that's your key high. We start to get a push through the MA, pop back up, consolidates around the MA and starts to expand lower. So I'm trying to take advantage of that. And again, here, it's below the MAs. We've got that pull back to the MAs, and I want to keep below that. And you can see that the MACD, for me, that's momentum. Momentum's on the downside. It's below the zero line. Okay, so below the zero line to me is sell, especially with that pullback to reversion to the mean, and that continuation style of trade. If I'm shorting, I want to be those, that MACD on the sell side, and the reverse for buying. And the same with momentum, I want it to be below the zero line. Okay, and if it pops back like this one is prime, this one even, that reversion, that's probably nice and early. I mean, it still worked out beautifully, but I haven't got a break. By then I actually have got a break. By the time this gets through this support line, I know that we've got our washout. That resistance zone is confirmed. We're getting sellers come in. We've got our lower high through here. And then all I really need is it to break that level. I'm happy to take that trade because my risk is going to be just above. This is prime as well. And you can see that the market knows, anyone that's bought it knows they're wrong by this stage because it really starts to accelerate to the downside. Okay, and again, the momentum's on the downside here. Reversion to the mean style of trading, and this one is more, the market pops up. So we talk a lot about this in that morning overview, and half my trades are based around reversion to the mean purely because if I'm trading the SPY around the open, a lot of the time it will accelerate one direction. And I know I probably can't get on board from the open because I don't know what's happening. But by the time the market plays out a bit, the only real style of trade that, 6 times out of 10 is going to be that reversion to the mean. And if I get a trade reversion to the mean, it starts to sit on top of the MAs, and I could turn around and look for a continuation. I could close one, open the next. Or, if you get something like this where it completely fails, that's fine. I'm just trying to ride it on the downside. And I'm using candles. So if this is a 5-minute candle, my entry is below you get your first red candle. I'm looking to try to enter on the break of that first red candle, the break of the low, and my stop's above the high. And I'm only really doing that if it's, I haven't got a 20-point candle. where I have to put 20 points above. I wouldn't even bother if it's 4, 5, 6, which happens quite a lot. And that's good in another way, because that means that it's expanding, 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 and all of a sudden you get, it can't expand higher anymore. It's running out of steam to the upside, and it's a narrow body, and it's a red candle, as in it's a negative candle. And for me, if it breaks to the downside, there's all this sort of, you know, short-term fuel that's built up that needs to get out, or they're going to want to get out. And I think it's a high sort of a hit rate on the short side, but it's not massive gains. Okay, you might be 65% right, but you're not going to get 3 or 4, 5 to 1. That's very rare. Sometimes you do get quite a good return, but more than often than not, it starts to hesitate around the averages, around the mid-level, around the moving average, the EMA, 20 EMA. So that's one example. There's another example on the buy side here. That's probably not as clear, but you know, same style of trade. All right, and here's just a couple of examples of some trades we've done, or I did on the SPY 200. So this is your base chart or your anchor chart on the 30-minute chart. This is the price action at that stage, and this is what played out. Okay, oh, sorry, this is actually the price action after the fact, but this is what I would do every morning. The market opens, it's open on this line, the vertical line there. It's just got through a key resistance zone, and then you can see it start to take off. So I've got my momentum on the upside. So I'm particularly looking for buys. I'm looking for buying opportunities, or that reversion to the mean style of trade. And generally what I'm looking for, we call M patterns. M patterns for a sell and a W pattern for a buy, and buy that. So that's an M pattern there. So if you're looking for the markets extended into the lows, I might look for something like that. Okay, and then I know where my entry, and I call that a W pattern. And the reverse on the upside. Okay, it's extended on the upside, and I might look for something like that, reversion to the mean. I know the mean might be somewhere down here, or the mean up here, and I'm looking for that reversion to the mean off an M pattern. I'll just highlight that, W, M. Okay, so that's quite a basic analysis, and that's a basic example of what I'm looking for. And here you got a sort of a wide-ranging M pattern, up, highs, pullback, M pattern here. You got a lower high. You can see the narrow range bars. It's starting to stall, ran out of steam, and then can't remember what I did here. I think I went short here, but didn't trade it for very long. I probably got 5 to 6, 7 points out of that, but it went to about 20 or 30. So yeah, that's one. Let's go. There's probably only 1 or 2 more, and then we might have to call it quits there and open it up for questions. Here's a good example of an M pattern. Market's gap down on the open. This could have been a sort of, we call it a gap and trap. So it's gap down. It's caught some sellers into the market who get trapped and they get squeezed back out on a return back to the mean. Then you've got the next pullback. I actually shorted this in here and took it off when I realized it wasn't going anywhere. No follow through. It did pop up. It took out the highs, but when it takes it out by 1 or 2 or 3 points, that's not a strong move. And it's interesting to note, this is a major M pattern. So we're looking at that major context. And then if you can see, what I could probably do is do one thing. I'll just do this. If you can see what I'm talking about there, that is a major M pattern. Within that, you've got like a little minor M pattern here. 1, 2, high, that. So you've got this little minor M pattern. So that there's a sell every day of the week. Okay, and just looking for that reversion to the mean. Does that make sense? I hope so. And then you can see what happened, what played out there. Pushed down, it really cleaned up a lot of these buys. So that's just all, again, it's all using an anchor chart, a 30-minute chart. That's a reversion to the mean style of trading. I think I've got another example of, well, there's another M pattern and W pattern there. If you want this information, you can always just shoot me an email. I can send you a copy of a PDF of the presentation. More than welcome. I'll show you the details just at the end in about a minute or 2. Yeah, so that's just some more examples of what we've been looking at. That one's on the Aussie. Another one on the Aussie. A few bits and pieces there. You can see M patterns playing out well, expansion lower, a W pattern, and then you're just looking for the entries. Nice entry here, another short entry there, and I've just marked up on that a whole lot of notes of if I don't trade it, a whole lot of notes on what I'm seeing and why. Does it set up or doesn't it set up, and what I want to see. It just helps me refine my trading. Another example, this is on the DAX. Again, you got sort of a W pattern here, and you got high, low starting to play out, so you want to be biased up, and you can see the MACD's on the upside, momentum's on the above the zero line. So I'm looking for a buy. I think there's enough fuel built up, sold into, they're starting to get squeezed out, and I want to see where it goes to. And you can see it did play out okay in the end. There was some more setups here. They were probably, it was really choppy at this stage, but you still, you've got a few points out here, a few points out here. Once it started to roll over, that was a short entry, and that's a continuation. It's got extended, and it's from the anchor chart. So the anchor chart, the momentum could be to the downside here at this stage. So momentum shifted. I don't know what the anchor chart's doing here, but this is just a 5-minute chart. I know my MACD's on the downside, momentum below the zero. Again, momentum below the zero, I'm looking for a short. Okay, if it's inside out, so inside out or outside in, it doesn't matter. Okay, I think that's about it. So that's, I guess, all I'll probably need to go through. Is there any questions? Anyone want to put in a question to the chat, and I'll see if I can answer it quickly, or we're all getting a bit tired. It is 9:30, just on 9:30. Or I'll just wait, give it a few minutes to see if there's any questions. So yeah, thanks very much for having me. I'll wait to see if there's anything pop up. But if you've got any more questions, that's the email address there, support@tradesetup.com.au. You can reach me on that, or there's a mobile number. I'm contactable on 0432 120 173. If you'd like to get involved, that's our website there, tradesetup.com.au, or just join in if you'd just like to join in the live streams. So we do a live stream on Monday where I just chat about the markets, talk about what I'm looking at. You can grab the information, just send me an email and I'll send you some links. And if you like, jump on TradingView. I know a lot of people use TradingView. We're going to start to get a lot more active on TradingView and putting up a few different ideas. And I think our handle, if you call it a handle, is capital T for trade _ capital S for setup. If you search that, you'll find it on there. There's probably only about 2 posts at the moment, but we'll be putting up a lot more information, market analysis, just bits and pieces to help away. All right, that's probably about it. No questions. I'll throw it over to Warren.
Okay, thanks, Braden. Yes, I don't think we've got many questions, but thanks for that. It's really appreciate the presentation, and I do similar trading myself, so I got a few tips out of it. So I really appreciate it.
Fantastic. I hope it's worthwhile.
Yeah. So as usual, the presentation will be put up on Facebook, and there'll also be a link. If anybody wants the presentation, sent directly to them, I have a link before the, while the website's getting updated. So anyone sends me an email, I'll send them a link to the presentation. I'll send you a copy, Braden, when it's edited. Thanks again. And the October meeting is Igor Vasilev. Daryl will be back, and the topic's selling naked puts. So thanks everybody for attending tonight, and we'll see you all later. Thanks again, Brad.